Let's talk about a profit and loss statement, also known as a P&L, profit and loss. A profit and loss statement in the mortgage world, when trying to buy real estate, residential real estate, whether it's buying your primary home or a vacation home or an investment property, there are going to be instances where a lender might require a P&L. So let me give you a quick little what you need to know. So understand, I don't represent every bank out there in the land, obviously, but what I'm going to give you is this is pretty solid as far as like 99% of the time, this is going to be true. I think I'm making up the 99, but the vast majority of the time, this is true. The P&L is a statement that just says, hey, here's where my business is right now. It shows the profit and the loss of the company. It would show the revenues. It would show expenses that come out. And then here's where we are today from a net income, hopefully net income, or a net loss of whatever company this is. So a P&L statement, when is it needed? Needed for the self-employed individuals when the underwriter or the investor, like that, whoever's going to own this mortgage, when they need to want to see what current income looks like. So let me give you a good example. Let's say we got a self-employed person buying a home in June. We'll say at the end of June, they're going to close. So that's 6 months of the year that have come by. And in doing the mortgage, because at this point, April's passed, right? Taxes should be due. And an underwriter might want to see, how is this business doing in the last 6 months? And so a quote normal, air quotes there, a normal mortgage, the Fannie Mae, the Freddie Mac, conventional financing, even FHA or VA, something like that, they're going to say, show me the tax returns for the last 2 years. So if they see tax returns for the last 2 years, let's say somebody's making 200 grand for income in the last 2 years. So both years, maybe the first one was 2 years ago, the tax returns were filed and it showed him making 150 grand. And then last year's tax returns that were filed showed that they made 200 grand. So if we use a 2-year average, that'd be about $175,000 income, if that's truly the net income to them, that this person, this example, can use to qualify for a mortgage. We would use the 2-year average. Well, the reason why the underwriter would then ask for a P&L is to make sure that year to date in June, when this example is closing, they want to make sure that that individual is still on pace to make at least the 200 grand or more. So the P&L doesn't qualify. And this is super important. I should have said this probably at the very start of the video. The P&L in the vast majority of the times will not be used to actually calculate income. It'll be used to validate income. So my example, if I don't care if year to date, these last 6 months, this person went from making 150 to 200,000 to now making 800 grand, it doesn't matter. They're not going to give that person 800 grand for qualifying income. They're not even going to consider it. What it does is it validates the income from the 200 grand from the last year. It'll validate that trend or that income is still existing and trending up. Because if that P&L shows up all of a sudden and shows that the income's back down to 150, right? So it went from 150 to 200, and now if a P&L shows that they're tracking down to 150, more questions are going to be asked. So I'm not saying the 150 shoots them out of the water and makes this thing a dead deal, but more questions are going to be asked. Because what if the cycle of this business is such that the second half of the year is where bigger revenues come in and all this, maybe it's cyclical or seasonal or something like that. So again, it's not to say it's going to get declined. I'm just saying the P&L is going to just validate income. But if they show that it's plain and easy and good and they're still trending 200 plus in this example, then they're going to be fine. So the P&L is there to validate the income. It's not there to determine or to create or calculate income. They're not going to use it. They might even, depending on just, again, the scenario, they might ask that P&L be audited by a CPA, meaning verified that it's accurate and true, because anybody can create a P&L, right? Whether it's through an Excel spreadsheet, something as basic as Excel, they can go in and say, this is revenue and expenses. And I've seen P&L guys where it's like 4 lines. Here's my revenue. Here's my 1 line of expenses, or I don't have any expenses, and here's my net income. Obviously, I don't say obviously, but most of the time P&Ls are more extensive than that, but anybody can create a P&L. So for an underwriter to feel comfortable, sometimes they might need a CPA to validate that, or a bookkeeper or some third party to just ensure and give some sort of like endorsement that, hey, this is accurate information, because what they don't want is somebody just making up a worksheet that says, hey, here's my P&L and I'm crushing it, when in fact the reality is they may not be. So sometimes they need it. I'll tell you, I don't see a lot of that. It's going to be, as far as requiring the audits, it's going to be based on, case by case. But the reality is, most of the time, if everything looks, like I said, congruent, where the P&L is matching up with years past as far as tax returns and expenses, and whether there's a large item expense, things like that. And now we're talking about just qualifying self-employed in general. I don't want to get into that, but the P&L is essentially just that fundamental reason why they need it, is to validate a trend so that they can feel comfortable using income that has been calculated based on past tax returns. So hopefully that answers your questions. Certainly, if you have more feedback or comments, you can reach out to the Mortgage Mark team. We are here to help. And as always, when you think mortgage, think Mark.